On YouTube, this is Calvin Russell here, CEO and founder 850 Club Credit Consultation. Hope everyone is doing well today. Okay, so a question I've been getting a lot, especially for a lot of people that have, of course, student loans and such. They want to know how it affects them buying a home, okay? And it most definitely does affect you buying a home, unfortunately. Student loans are counted against your debt to income, okay? Now, depending on the lender, they're probably going to take a certain percentage and they're going to assume if you were making payments on your, okay, let me just break it down a little bit like this. If you're making payments on your student loans, you probably have a certain set payment already. Okay, that could be $5 a month, $10 a month, $20 a month, even $100 a month. That's not how most lenders are going to calculate that. Okay, what they're going to do, they're going to take the overall amount and they're going to divide it by 25 years, and they're going to go usually the average interest rate is usually about 5 to 6%. That's what most lenders do. Okay, whatever that number comes out to, they're going to add that to your debt to income, your monthly debt to income. Once they do that, then that's going to adjust the amount of pretty much your purchasing power. For example, if a person has $50,000 in student loan debt versus a person that has, let's say, $75,000 in student loan debt, the one that has $75,000 worth of student loan debt is going to get approved for a lot lesser amount. Okay, assuming though income is going to play a major role. So they're going to look at income. They're going to look at everything you pay monthly that is credit based. Okay. Again, everything that you pay monthly that is credit based. So for example, your cell phone bill does not count. Your rent does not count. Okay. Your people's gas. Well, I'm in Illinois. So your gas bill does not count. Your electricity bill does not count. What counts? Again, things that are on your credit report. Okay. That's what counts. Credit cards. So they look at your monthly payment for all of your credit cards. If you look at your credit report, there's a monthly payment. Even if it's a minimum monthly payment, they count that against you. So they're going to count everything that's on your credit report. So that's going to be your credit cards. That's going to be your auto loan. And then, of course, if you have student loans, of course, then that's going to be, again, accounted against you. Most lenders are going to take your total amount of student loans divided by 25 years, and they're going to usually go the average rate of about 5 to 6 years. And they're going to come up with a payment. Then that's going to be added to your debt to income. Okay, that doesn't matter if you have, I think the cutoff is like maybe 20,000 or something like that. Anything less than that, they're probably just going to look at whatever structured payment that you have right now. All that counts against you when you're looking for a home. That goes against your DTI, also known as your debt to income. Now, every lender is going to be different in terms of the max debt to income. Some lenders will go 50%, some will go, the national average is about 43%, but some lenders go a little bit higher, 45, 49, 50, 52, and that's debt to income. What that means is that they're going to allow you to have more house. Does that mean that you can shop around for rates with different lenders? Yeah, but the process, it just takes a longer time. It's not like getting a car. With getting a car, you go to a dealership, you have 30 days, by the way. The FICO algorithm, not the Credit Karma, Credit Sesame, not all that other stuff that uses Vantage 3.0. There's nothing wrong with Vantage 3.0, but Vantage 3.0 does not, it counts every single inquiry against you. Versus FICO, they give you the rate shopping law. The rate shopping law is you have 30 days to go to, that's for only for auto loans and that's for home loans. You have 30 days to get to do what they call a rate shop. Okay. So that means that you can go to a dealership day 1, go to another dealership day 3, another dealership day 10, and kind of shop the rate. The thing is that all the rates are going to be about the same, okay? Because everyone's using about the same banks in the auto industry. Versus going into the home industry, the rates are going to be the same, but the buying power may be a little bit different because every lender is different. This is a true story. One of my clients went to a bank and they said that he can get 125,000. Okay, he went to another lender and now, of course, he was able to get 180,000. That's a huge difference, and all he did was change lenders. Okay, and so that just plays a bigger role. And again, every lender is going to be different, but again, they won't be able to tell you every single number unless they run your credit, unfortunately. Then not only that, they look at tax documents, check stubs, all this stuff. So it's just a lot of time. It's very time consuming. Much you guys' time, but again, that's how your student loans are going to affect you. It's going to go directly against your debt to income. It's very unfortunate because again, just by doing what everyone told you to do, go to school, get good grades, get a good job, but now it makes everything a lot more difficult to actually go into home ownership, and that kind of sucks because you did absolutely nothing wrong. And there are some people that got like over $200,000 worth of student loan debt, $100,000 worth of student loan debt. You better find yourself a spouse real quick because when you have two people on a loan, that's another thing I've seen that works out pretty well. When you have one person person that has student loan debt, and then their significant other does not have student loan debt, but you now have two incomes, you have stronger buying power. Okay. So, but what really sucks is when both you guys have extremely high student loan debt, and then of course you have, both your incomes. That doesn't mean that you cannot buy a house. That just means that your buying power is going to be as strong. Again, living in Illinois, you got to have to get like a nice home, you got to be in that 120 range, 120. It's not that it's difficult to find homes. Again, everyone's situation is going to be a little bit different, but you want to most definitely make sure that you look at all of your options. You can always call without getting your credit ran. So we got a quick question here. Do you have problems with removing student loans? Because I've been able to remove them with the ease of federal and private. Again, it's not about removing student loans, okay? The problem is people's expectations. Just because student loans are off your credit report does not mean that you don't owe them. I'm going to do another video on that. Again, I'll say it one more time. Just because student loans are not on your credit report does not mean that you do not owe them. You still owe them. Listen. Don't pay them and see what happens, okay? And I've also seen it where sometimes people get on their credit reports and people are able to get them off. It's not about getting things removed. I'm just saying because everyone doesn't hire us to try to get things removed. Everyone doesn't go into credit repair. Everyone doesn't go into those types of things. And so again, it's not about trying to get items removed, which I think was a shameless plug, by the way, but no problem. At the same time, it's more so about, again, everyone's having the expectations. The thing about it is that there's a lot of bad advice out here on Google, on YouTube. And what I'm finding is that everyone that's giving this same advice, they don't own homes, okay? So again, if your goal is home ownership, talk to people that own homes, okay? If they don't own a home, they can't really give you advice on doing so. That doesn't mean that things are not going right in their life, anything like that. It's the same thing with buying a new car. If they've never bought a brand new car before, they can't give you advice on how to buy a brand new car. If they've never been a landlord before, they cannot give you advice on being a landlord. So again, this is your financial life. It's okay to ask questions. You can ask questions before getting your credit ran, guys. And again, it's going to count against your debt to income, okay? You don't want to be sitting there just trying to get things removed or whatever, because again, if it pops up and you look crazy, now because again, it's not like an auto loan where you get your credit ran and then of course you buy the car, you leave that same day. That's not how home buying works. You have underwriters. Underwriters give things time. They want to make sure. And so you have to find the house. Okay, so you get your credit ran, then you find the house, then you close. That takes 45 to 60 days, that entire process. You better believe we're waiting for something to change on your credit report. Okay, I'm talking about removing them, and there's no payment, not a credit sweep deletion, and there is not a repayment. Again, I've never heard of that before. You're more than welcome to promote whatever you want to promote. At the same time, I've helped people buy homes and they've never had issues before, just setting the right expectations. I would hate for someone to hear me say something about that. And again, I have yet to find a lender that has not gone another way to try to keep that from happening, okay? So again, you can do whatever you guys want to do. I'm just letting you know. Another question, should I pay down my student loans as much as possible before I apply for a home loan? Not necessarily. I say go try to get the loan first. They're not that crazy about it. So for example, if you have let's say that your income is, let's say 60,000 and your student loans are 60,000, you're probably going to have buying power around 130, 140. Okay. So it's not like it's horrible. Okay. So if I could give you guys a number, what I always tell people to do is add your income up and then add your student loans up. That's normally what your buying power is going to be, maybe about minus maybe 20 or 30,000. That's what I'm starting to see in Illinois a lot. Okay. So again, everyone's situation is going to be different, but I'm telling you, everyone that has student loans, I'm telling you, it will count against your debt to income. That does not mean that you cannot buy a house. But again, you can always use that money for down payment. But again, I would go to a lender first and see. But remember though, don't forget to watch the video I made before, the first time home buyer checklist for 2018. You want to get your FICO score first. Get your FICO score first, okay? I know there's a lot of different programs out here where people are trying to say that you don't have to pay your student loans. Okay, here's the deal. I'm not even gonna do that on this video. I promise you I'm not. I don't want to hurt people's feelings, because again, I'm not that guy. All I know is that these schools get money from students and from the government, and then of course the students are supposed to pay it back. If the students don't pay it back, I promise you there's gonna be some issues later down the line. Okay. Otherwise, there will be somebody promoting these types of programs, whatever the case may be. I'm not knocking the programs. I'm just saying I've yet to see a homeowner do it successfully, okay? Because all of my clients that are buying homes, they're having no issues at all. Thank you guys so much. Share this video, like it, and as always, we got a lot of more videos coming up on the way, so be sure to subscribe as well too. Thank you guys so much.